Hello investors, welcome to my channel. Pat Gelsinger is the main responsible to make a successful turnaround for Intel. You need to remember that 3 years ago the company had problems to manufacturing and deliver its 7 nanometer process. So of course that was an opportunity taken by competitors like Advanced Micro Devices, NVIDIA or even Qualcomm. And not only that, in the case of the foundry services, the company Intel is competing directly with Taiwan Semiconductors, and we know that Taiwan Semiconductor is offering a better technology in the manufacturing of the chips because it is using the DUV lithography equipment provided by ASML, which is a company that we could talk about in later videos. Then, well, the thing here is that Intel requires a successful turnaround, and of course, in this matter, Pat Gelsinger established a roadmap to overcome different milestones for the next 3-4 years here. So the market really don't know if Pat Gelsinger will be successful or not in this journey. But of course, we as an investors, we need to establish what are the probabilities that this could happen in order to determine if really Intel could fit well in our portfolio for the long term. So the purpose of this video is to offer the relevant information about Intel in order for you to find out if Intel really fits well in your own portfolio. So the first thing that I will do is to show you what is the roadmap of the company established by Pat Gelsinger for the next 3 or 4 years in order to see if really Pat Gelsinger will be able to recover the market position of Intel. Then I will present to you what are the metrics of the company, and I will compare with the metrics of AMD and NVIDIA in order to know if there is a solid base for Intel to start this new turnaround that is possible under the tenor of Pat Gelsinger. Then I will present to you my calculation of the intrinsic value in which, well, I'm incorporated in the money that it will be required for Intel to make this turnaround, which is something that like $100 billion approximately. And I want to include all that money into the DCF in order to have a better approximation of the intrinsic value for this company. Then I will make something different here because I feel curious about what has been the performance of Pat Gelsinger before taking over as a CEO in Intel. So you know that Pat Gelsinger was the CEO of VMWARE, in which, well, he was there for almost 10 years. So we could explore what are the metrics of the company, and we will see if the really Pat Gelsinger was delivering value for the shareholders of that company. So in that way, looking into the past, we will be able to make a decent forecast about what we could expect about Pat Gelsinger in Intel, and we will know if Pat Gelsinger will be successful or has a higher chances to make a successful turnaround for Intel. Then I will show to you what could be the potential catalyzers, potential risks, and of course the potential mitigations to those risks in order for you to have a clear picture about what we could expect about Intel as a long-term investment. In the last part, I will make just a brief comment respect to the vision of Warren Buffett and Charlie Munger respect to the semiconductor industry. You know that the semiconductor industry is not precisely within the circle of competence of these two super investors. But of course, it is always worth to listen what they have to say about this industry because you know that the semiconductor industry is really a hard industry in which it is really difficult to make predictions for the very long term. Really, we don't know what we could expect in the future respect to the evolution of all the players in this industry. So that would be really interesting to know the vision and the perspective of these two super investors. So I will start right now. So this is the roadmap here. This is all the processes in which, well, this is throughout the time over the years, in all the advances that Intel has made here in the semiconductor industry. And if we focus here in the Intel 10 nanometers here, you remember 3 years ago, it was supposed that Intel would release the 7 nanometer process here. But of course, there was certain problems in the manufacturing, and then of course that was an opportunity taken by companies like Taiwan Semiconductor to offer the 7 nanometer process node to the market. And of course, you need to remember that the customers of Taiwan Semiconductor are precisely AMD, NVIDIA, or Qualcomm, and they have taken advantage of this technology of the 7 nanometer process to offer better chips to the market, and that of course was something bad for the market position of Intel. Now, the response of Intel to this threat was to develop the 10 nanometer superfilm here. So it means that this is an improved version, a better version from this version of 10 nanometers here. So it is supposed that Intel want manufacture a 10 nanometer enhanced that could compete with the 7 nanometer node offered by Taiwan Semiconductor. Of course, there has been problems respect to the marketing of this product, because for the customers' minds, the 7 nanometer will be always ahead of the 10 nanometer. So that was a problem, and that's why Intel, when Pat Gelsinger or Intel in general were establishing the roadmap for the next 5 years, they decided to change the way in which they were making the marketing here. Look at this. We are right now in Intel 7, and that doesn't mean that Intel is offering the 7 nanometer yet, because, well, it is still offering the 10 nanometer superfilm, but an enhanced version, an even better version than this previous version here. And of course, they are claiming that the number of transistors are comparable to the number of transistors in the process offered by Taiwan Semiconductor here. But then it is expected that in the second half of this year, in the year 2022, Intel will release the Intel 4, which means that in Intel 4, Intel will release its 7 nanometer process finally, and they will use, of course, they will need to use the EUV lithography equipment, which is a machine, a very advanced machine, a very advanced equipment provided by ASML, which is a company that we could talk about in later videos, because it's really interesting, because that company really has the monopoly in the supply of these kind of machines. And something important to notice is that this EUV lithography equipment is already used by Taiwan Semiconductor 3 years ago. So you can imagine all the advantage that Taiwan Semiconductor has had in the last 3 years respect to the market position of Intel. Really, Taiwan Semiconductor, that's one of the main reasons why Taiwan Semiconductor was offering a better technology with a lower nanometer processes here, using this kind of EUV lithography equipment here. In the year 2023, in the second half, it is expected that Intel will release the Intel 3 here. Of course, it is expected a lower nanometer than 7, okay? And then in the year 2024, in the second half, it is expected to launch that Intel would launch for production the Intel 20A, and the company is already working with Qualcomm in the development of this technology Ribbon Fed here. So now in the year 2025, this is something that does not appear here in the chart. The Intel would release the Intel 18A, which is a project in which Intel is already working with ASML to develop a new generation of EUV lithography to manufacturing and to produce these kind of new chips, more advanced here for the year 2025. So really, the company really will need to, in order to comply with this roadmap, the company will need enormous amount of money here, and that is something that I will include in my calculation of the intrinsic value, because of course we need to know if really is worth at least to see if this company could be a great opportunity for our portfolio. Now, something important here to notice is that there could be problems in the manufacturing of any of these future technologies here. There could be delays, there could be problems in the design, there could be problems in the manufacturing. So of course, but well, at least I would say that the current price of Intel right now is already taking the possibility that this is something that could happen, okay? You know that the price to earnings ratio right now of Intel is less than 10 or 10 or 11 or less than 10 times the earnings per share. So really the market is not so much optimistic about the future about the possibility that Pat Gelsinger could fulfill his promises respect to the roadmap. So really, if we are considering Intel, really we are buying the possibility that Pat Gelsinger could surprise the market complying this roadmap, which of course could be really an interesting trigger for more value in the long, at least for the next 5 years here. So this is the kind of thing that I will assess in this video right now. So this is the market share respect to the CPU market, which is the most important segment of the market for Intel. I mean, in terms of revenues, this CPU market contribute with more than 50%, and in terms of the earnings before interest, expenses, and taxes, the contribution of this segment of the market in Intel is more than 70% here. So really, it is important for Intel, this business unit, and you can notice that the Intel has been the leader over all these years since the year 2012 to the year 2022 here to the first quarter of the year 2022. But of course, since the year 2018, the AMD Advanced Micro Devices has eaten market share to Intel in this business unit. And this is because, well, there was a delay in the 7 nanometer process node. And of course, Advanced Micro Devices has made an outstanding job in the way in which they make the marketing of its products, the marketing of its chips, and they have made important acquisitions and so forth. So they have built up, of course, an interesting business model. They have reinforced their business model here. So really, it would be, of course, it could be a threat to Intel in this business unit. But of course, something that I cannot deny is that it is really hard to make a prediction what will happen in this business unit between these two companies, because of course Intel has the enough resources to reinforce its business. It will depend on Pat Gelsinger here to reinforce the business model of Intel, to continuously being the leader in these business units in the future, at least for the next 5, 6, or even 7 years. Look at this in the case of Pat Gelsinger. Well, he has taken over at the beginning of the year 2021, so we could see a recovery in the market share here of Intel here respect to respect to the market share of AMD. But anyway, it is hard to make a prediction here. So that's why it is important to determine if Pat Gelsinger will be able to create more value for the shareholders of Intel, and that is important. That is important to focus in the way in which he is taking decisions, management decisions for the future of Intel here. And this is something that we will assess later here. So this is the breakdown in revenues of Intel here. I just collected all this data directly from the annual reports of the company from the year 2017 to the year 2021 here. And you can notice that the client computing group is the most important business unit of Intel here, which includes the CPU market or segment of the market here. So it is really the most important business unit for Intel here, and it has been declining in terms of the participation of total revenues here. You can notice, whereas in the case of the data center group, the participation in revenues has been increasing here, and that was part of Bob Swan's strategy. You know that Bob Swan was the CEO before Pat Gelsinger, and I think that Bob Swan was right in making the transition from the client computing group toward the data center group, but unfortunately, I would say that the path that he has taken to make that transition was not right here. But still, in terms of the profitability, in terms of the earnings before interest, expenses, and taxes, the client computing group still represent more than 70% of the total profitability here, which is something that Pat Gelsinger needs to take into account, because the data center group has been declining its participation within the profitability. And if you want to make a transition towards the data center group, the data center group, of course, needs to have a higher participation within the profitability, which is something that should be expected. But that's why I'm saying that Pat Gelsinger needs to take into account as part of its long-term strategy here. I just want to make a brief comment with respect to the Mobileye here. You know that it is expected that there could be Mobileye's IPO. I mean, and a spin-off Mobileye. Mobileye is offer systems and data for autonomous driving, autonomous vehicles, and the company already has important clients. More than 25 international automakers are using the technology and services of Mobileye here. Among all these clients, we can name Volkswagen, Ford, General Motors here. So this is a company that is well established in its own market here, and the company, of course, has an enormous potential for the future. But unfortunately, we are talking about a company, a subsidiary that only contributes less than 2% in terms of the total revenues of Intel here. But still, the company is really profitable, because if you divide, of course, the earnings before interest, expense, and taxes by the total sales of the company, you will have a 33% of profitability here, which is something meaningful here. So we are talking about a company that is not new. It is a company well established and that was founded in the year 1999. So really, the company has an enormous potential here, but I wouldn't count it as a significant catalyzer, at least for the next 5 years. Something important to notice is that it is estimated, I mean, we don't have so much information with respect to Mobileye here, but it is estimated that the market cap for the IPO could be something like 50 billion. If you divide 50 billion by the total sales of the company in the year 2021, 1.3 billion, it means that the company will trade something like 50 times sales, which is really expensive, really. And most likely part of this is IPO, part of this spin-off, that Intel is planning to keep the majority of the shares of Mobileye here. So really, probably what Intel wants to do is to raise capital here in order to support this long-term strategy. You know that Intel will need something like 100 billion to support its long-term strategy for the next 5 years to recover its market position here. But what happened, for example, if Intel failed in its long-term strategy of the next 5 years, using the capital risen by the Mobileye's IPO, I would say that, of course, that could be disappointing for the market, for the Intel shareholders. That's why I would say that the market and general potential investors are cautious respect to consider a Mobileye's IPO as a potential catalyzer for Intel for the next 5 years. It could be a catalyzer for the very long term, of course, as Mobileye continuously growing for the very long term, and that, of course, could create more value for the shareholders of Intel. But of course, for the next 5 years, I wouldn't count it as a potential or significant catalyzer for Intel shareholders here. So these are the metrics of Intel here. I just collected all this data directly from the financial statements of the company from the year 2012 to the year 2021 here. And the first thing that I will do is to focus in the growth in sales of in the last years here. You can notice that the growth in sales in general and then has been rather low compared to the main competitors of Intel, Advanced Micro Devices, and NVIDIA here. There is something wrong here in the application of this strategy before Pat Gelsinger here, because you know that the semiconductor industry offers so much room to grow for many of the players that are within that industry. So there is something wrong here that we will need to discover here, but we will come back to this. The first thing that I will want to show you is that in general, Intel has been really a good company that is able to reinvest into its own business at a higher return of equity and at a higher return of invested capital, with more than 20% in both cases here. So really, the company has certain power in its industry here, and this is a work that Intel has built up over decades. But of course, those metrics cannot tell us anything about the long-term strategy that the company is applying for the future, really. And of course, in the case of the net margins here, the net income divided by the revenues here, the company is offering more than 20% in profitability here, which means that the company really is offering technology, chips, and different products that are really well demanded by its current customers here, and the customers are willing to pay the prices set by Intel here. Another important point is respect to the how strong is the balance sheet of the company here. If you for example, we divide the long-term debt, which is the majority of the total debt here, and we divide it by the net income, you can notice that all this long-term debt can be paid by the company using its net income in less than 2 years. So really the company has been consistent here in its policy of holding acceptable levels of debt here, which strengthens its financial position here, which is something really good is to make a successful, to have a solid base to start a new strategy here for the next 4 years. Another important point is that we can highlight that the company has an interesting cash imbalance here, 4.8 billion, which do not covers the total debt of the company, but at least it can cover the short-term debt in each of the previous years here. But something important to notice here is that the company not only is holding cash and equivalents of 4.8 billion, as it is the case here in 2021 here. The company is also holding short-term investments and trading assets, both of them some 23.5 billion here, which can be used by the company. The company can turn all these short-term investments into liquidity if the company feels that there is a short-term requirements to afford here. So really that indicates how strong is the company in terms of balance sheet here. Important thing to understand is how the company was able to deliver, was allocating the free cash flow, because really the free cash flow of the company has been consistent in the last 10 years here. If you compare the free cash flow with respect to revenues here, you can notice that the percentage we divide the free cash flow over revenues here, you can notice that there is an important production of free cash flow respect to revenues here of more than 20% in most of the cases here, which is a really good metric, because you can compare with other outstanding companies like Apple, for example, or like Alphabet. Both of them are producing more than 20% of free cash flow divided by revenues. So really, it is a good indication that the company is not in a bad shape in terms of financial performance, really. So the problem here is that what is the underlying strategy of the company here with respect to the future? Because you know that we are in the semiconductor industry, and really it is a really hard industry in which all the players need to reinvest in its core business in order to remain competitive, because Intel really has formidable competitors here like Advanced Micro Devices or NVIDIA. So what has concerned me is that despite all these good metrics, the company was not growing well here. And the semiconductor industry is an industry that is offering so much room to grow. So there is something that is wrong here. If the company was able to deliver this kind of free cash flow, this important amount of free cash flow year by year, why the company was not able to deliver a higher growth here in sales here in general? I would expect something like 12%, 10% in a consistent way in all the years, but this is not something that is happening here. So really, we need to discover how the company was allocating the free cash flow year over year. Just look at this. If we see, for example, the dividends here, the company has been paying important amount of money in dividends here, 4.6 billion, 5.5 billion, 5.5 billion. So really, this is an important portion. If you divide the dividends by the free cash flow, you can see that in most of the cases, the portion of allocated to dividends could represent 40%, 50% of total free cash flow here. And not only that, the company was increasing its dividend payments over the years, which means that the company really wanted to attract more dividend investors here. And you can notice that all this money could have been used to reinvest into its own business to remain competitive here. But of course, if the company was doing something like that, allocating an important amount of dividends here, it means that the previous management felt overconfident about the growth prospects of Intel. Probably the Bob Swan felt that the company would not face a strong threat by competitors here, and that's why most of the money that Intel was receiving for its operations was used to pay dividends instead of reinvesting into its core business to reinforce its market position, to offer better chips, to offer better technology, and so forth. And look at this, the dividend yield here. If you divide here the dividends per share by the current price, you can notice that the dividend yield is really high. If you compare the dividend yields compared to all the players of the semiconductor industry, you will discover that Intel is offering a really attractive dividend yield here. But not only that, the company was using as well in making repurchases. Look at how was the proportion of the repurchases with respect to the free cash flow here. It's a really important proportion of free cash flow here, which means that, I mean, you can conclude looking this just into the numbers here that the company was using most of its money to make dividend payments and to make repurchases, which is not something bad, but of course that means that the company was reinvesting less money into its core business to reinforce its market position. And in the end, for example, if the company would have invested much more money into its core business, probably the company would not have had any problem with in its delay of its 7 nanometer process nodes. And of course, the company would be in a better position right now. And a successful turnaround will not be required at this time. So these are the metrics of NVIDIA here. I've just collected all this data directly from the financial statements of the company here from the year 2009 to the year 2021 here. And something important in order to see what was the strategy of NVIDIA here in the long term was to deliver high growth in sales here. Look at the growth here of sales of 38, 41, 21, well, except this 53 and 61% in year over year in the last years. I mean, if you compare that growth with the growth of Intel here, you can notice that the strategy of NVIDIA was completely different here. You should remember that NVIDIA is the leader of the market in the GPU architecture, which could be adapted to different applications. And those are future sources of growth for the company. So really the market really knows about the amazing growth prospects of this company here. But the long-term strategy of NVIDIA was not only growing at higher pace, but also to be really profitable. If you can notice here the return of invested capital and return of equity, the company is really offering really high returns for the capital here. Some years the company is offering better return of equity and better return of invested capital. Of course, you can notice that Intel is offering really good metrics, but Nvidia is offering slightly better returns here for its capital here. Capital investment. And now the case of the net margins, you can notice that the net margins has been increasing in the case of Nvidia over the years, and this is because the company was increasing its power to set higher prices, because the company has a reputation of offering different better performance products, chips, and technology to its customers here, and that of course really gives the power to set higher prices for its products and technology. For example, in the case of Intel, the net margins of the company has been rather flat over the years, but in the case of Nvidia, it really has been growing these net margins here. It is really clear the strategy of the company, but you can notice that the main difference between Nvidia and Intel has been how the company has a completely different strategy in how to use its money to deliver higher growth here. Look at this. You can notice here free cash flow. The company has been delivering not only a predictable but unstable, but also growing free cash flow over the years here as the company was growing here. This is whereas in the case of Intel, really the company has been rather flat in terms of the free cash flow generation, because the company was not reinvesting so much in finding new markets, in capturing more new clients, important clients, or expanding its operations here to new clients or new segment of the market. So really, there has been an important difference in how both companies have been using its resources and money here. And then, well, you can notice here that how Nvidia was using the money of the free cash flow here. The dividends has been increasing, but you can notice that if you compare the dividends respect to the free cash flow, several years the dividends has been lower than 10%, in some cases lower than 5% of the total free cash flow, which is a completely different situation with Intel. If you divide the total dividends per share in average respect to the earnings per share in average in the last 5 years, you can notice that NVIDIA only paid 8% of total dividends respect to the earnings, whereas in the case of the Intel, allocated a higher portion, way higher portion of its earnings here to make dividend payments here. So you can realize here how both companies have been using their money here. And not only that, you can notice here in the repurchases that the company, that NVIDIA stopped making repurchases in the last 3 years, in the year 2021, 2020, and 2019 here. And this is, if you remember, in the last 2 years, the company experienced, I mean, NVIDIA stock has experienced an important surge in its stock market price here. So probably this is how the management didn't want to buy its own shares at a higher price, at an expensive price, really. Whereas in the case of Intel, Intel was consistent, using a great part of its money in making repurchases. So here, clearly, the company, NVIDIA, wanted to use all that money that could have been using to make repurchases, or could have been used to pay more dividends. They preferred to use all that money to develop or to offer a better technology with a better performance to the market. And in that way, it was really, really profitable, because the company has delivered this kind of growth here, which is really, really good here. So I would say that in terms of quality, there's no doubt that NVIDIA is a better company. But something that you need to take into account, not necessarily a company with a better quality is the best investment. You can notice here that the price to earnings ratio has been really high in the case of NVIDIA, and whereas in the case of Intel, well, it has been really low, really, well, something between 10 times per price to earnings ratio. Here, this is really high, a price to earnings ratio here, because the market knows about the prospects of this company here, for future growth here. So really, it is important to know what is the price that you are paying for any of these companies. The purpose of this video is not to show you what is the intrinsic value of NVIDIA, but of course, something you need to take into account is that the price that you want to pay for this company will really matters, because that will influence in your long-term returns. The higher the price you pay, the lower your long-term returns will be, which is something that we repeated so much in this channel. And in here, Intel could be really a good investment if you pay the adequate price here, considering that the market is really not so much optimistic about the potential turnaround by Pat Gelsinger. This is something that we could see as an opportunity here. And something that I didn't mention is the fact that in the case of Intel, you know that NVIDIA did not offer foundry services, and the company really relies in the chips manufactured by Taiwan Semiconductor. But what happened, for example, if Intel really, I mean, Pat Gelsinger really achieved to implement its strategy for the next 5 years here, improving the services of its foundry services to compete in a better way with Taiwan Semiconductor. You can imagine that in the long term, NVIDIA or Advanced Micro Devices could be future clients of the foundry services of supply by Intel. So really, Intel really has the chance to turn these foundry services into a really strategic business unit here. And apparently the previous management under Bob Swan's tenure didn't realize that. So really, I think that Pat Gelsinger has a really, really great, a big opportunity to make a successful turnaround here. So these are the metrics of Advanced Micro Devices here. I've taken all the data directly from the financial statements of the company here. And then, well, you can notice that the company has not been performing well in the year 2012 to the year 2017 here. Well, apparently the company wanted to make strong investments in its operations, in its products, in order to offer better products and better technology to the market. And then, well, you can notice that in the last 3 years, in general, you can notice here that in the last 3 years, the company was improving substantially its return of equity, its return of invested capital here, and its net margins here, really, the growth here in revenues, which was outstanding here in the last 2 years, as it was the case of NVIDIA here, that really, well, most of the metrics of this company were improving in the last 3 years here. Something important to notice is how the company was really using its money, because the long-term strategy of this company was completely different in respect to Intel here. You can notice that the company is not paying dividends, and that the company is not making repurchases here of its own shares except in the year 2021 here. So that means that most of the time the company was reinvesting into its own business, making acquisitions. Well, I have in my mind the acquisition of Xilinx and Pensando. Both companies are offering advanced micro devices the opportunity to get into new different markets that could represent future sources of growth here for this company. So I would say that the company really has interesting opportunities to continuously growing. But of course, the market knows that, and that's why the company was trading at a higher multiple here respect to the earnings here. Both companies, Advanced Micro Devices and NVIDIA, were we're using the money in a different way, reinvesting more in its own business, reinvesting more in the technology that they were offering, and that was an advantage over Intel here, who were a company that was more concerned to pay to make dividend payments and repurchases and not invest so much in its core business in order to be more competitive against advanced micro devices and Nvidia. But of course, you need to remember that Intel has something completely different here that could be used as an advantage here, which is the foundry services in order to compete directly with Taiwan Semiconductor. And you know that Advanced Micro Devices or NVIDIA are relying entirely in the Taiwan Semiconductor manufacturing of the chips here. So really, if really Pat Gelsinger is really successful in making this turnaround, I think that Intel could take advantage of the foundry services, and that could be a future strategic business unit for Intel here. Now, one of the ratios that are most commonly used by Warren Buffett to assess different companies is one that indicates how much value was created for the shareholders by $1 of retained earnings. And this is the kind of ratio that I want to show you in Intel, NVIDIA, and advanced micro devices here. So really, the simple rule of this ratio is that according to Warren Buffett, a company should be able to deliver at least $1 of $1 of value creation over a certain number of years by $1 of retained earnings. And look at this. In order to construct this simple ratio, in order to see if Intel has been able to deliver some value in the last 10 years, we will just take the market capitalization. You know that the market capitalization is just the price, the stock market price multiplied by the outstanding number of shares. And then, well, I'm just taking the period of 2012 to the year 2021 here, and I'm just taking the market cap, the market capitalization and of the year 2012 and the market capitalization of the year 2021 here. And I'm just subtracting both numbers, and in that way we will have how we will know how much value was being accumulated over all these years for Intel here. And then I will take the retained earnings, which is something really simple to calculate here. The retained earnings and in the years 2012 to the year 2021 here. The only thing that I will do is to take all this net income from the year 2012 to the year 2021 here, and I will just sum all these numbers here from all this year, all this net income. I'm subtracting the sum of all the dividends here. So you can see here that we are calculating. We have the sum of all the net income minus the sum of all the dividends here, and in that way you will have the accumulated retained earnings in all this period here of the year 2012 to the year 2021 here. And then you can just divide both numbers and you will have something like this. In the case of Intel, Intel was able to deliver more than $1 in value creation for the shareholders by $1 of retained earnings in the period of 2012 to the year 2021 here. This is important because at least the company was able to fulfill the simple rule of Warren Buffett. But look at this in the case of NVIDIA and advanced micro devices. Following the same process, NVIDIA was able to deliver $29.49 by $1 of retained earnings. I mean, this $29.49 is the value created for the shareholders of NVIDIA during all this period here, during all these years here, 10 years approximately here. So really, and in the case of advanced micro devices, the same thing happened. I mean, it's outstanding how both companies were able to deliver so much value by $1 retained earnings here of the company. So I would say that the market is rewarding both companies because NVIDIA and advanced micro devices were able to establish a long-term strategy here to continuously grow going to continuously expand their operation, to continue to expand their markets at which they could attend with its better performance chips and technology here. But of course, given the fact that in case of Intel, we are in a transition here, Intel is starting a new transition, new turnaround with a solid base here, because at least the company is able to deliver $1 of value creation for the shareholders by $1 of retained earnings in the last 10 years, which is something that reinforced the idea that I had respect to Intel, respect to the fact that Intel is really starting with a solid base in its financial position to start a new change. And of course, it will depend on Pat Gelsinger in his ability and experience to make these turnarounds. So this is my calculation of the intrinsic value here for Intel. I'm just making some assumptions here in order to simplify this calculation here. So the first thing that I will show to you is, well, I'm assuming here that in these years, from the year 2022 to the year 2026, the company will make a strong investment in order to fulfill its roadmap here. So that includes, of course, the implementation of new fabs, the development of new technology to offer to the market, in order to catch up its main competitors and recover the market position of Intel here under the leadership of Pat Gelsinger here. I'm just incorporating this investment because according to certain articles of Seeking Alpha and according to certain analysts, the company will require something like 100 billion for the next 5 years. So I'm just including those 100 billion here as part of the total debt here. I don't know honestly how the company will finance all this transition here, but of course the company will need to do so in different ways. For example, the company can reduce its repurchases of its own shares, or the company could ask for more loans to the banks, could issue some corporate bonds, or could take part of the capital that the company will raise with the Mobileye's IPO. I mean, there are different ways in which a company like Intel could really get the financing for all this transition. But I'm just assuming a simplification here in order to incorporate in my model to incorporate all this requirement of 100 billion in order to see how that could affect our intrinsic value from year 2022 to the year 2026. I'm assuming just a sales growth here of 1% here year by year. And I'm taking here the revenues of the last year according to the last annual report in the year 2021 here. And I'm just using the forecast that I'm making here of 1% year by year for the revenues. And then I will use this percentage of free cash flow over revenues, 17%. You know that in the past, the company was really able to deliver a way higher percentage of free cash flow over revenues in the past 10 years. So really, I think that I'm being really conservative here, considering just a 17% here. Once we have this period, it is supposed that in the year 2027, the company will finish to make more investments, and then the company will take advantage of all those investments that the company has made in all this period here. So, really, I'm assuming that just a 10% of increase in the growth in sales here. But of course, I know that the company could be able to deliver a higher growth here. But of course, I like to be really conservative here, so really just considering 10%. And then I will still consider 17%, despite the fact that the company could increase its power to generate more free cash flow here at this point, after all the investments that the company has made here in all these years. So really, anyway, I like to be really conservative. You know that I like to put myself in the worst case scenario, because I don't want to consider any other scenario here optimistic or any other scenario, because all the other scenarios could take care of themselves. Really, if I feel comfortable with the worst case scenario in a company, I would say that could be really a good opportunity to consider here. Once we have that, we could consider then that there is a perpetuity here in order to make evaluation, and I will consider that there is just a 4% here, a 4% of growth in free cash flow here. So really, if we consider that there is a perpetuity here in all these years, in order to calculate the present value of all this perpetuity, we will take the first term here, the first term of the perpetuity of this sequence, and we will consider 8%. And then I'm considering this 4% of growth or future growth year by year of the free cash flow, even when the company could be really able to deliver a higher growth than 4%. But I like to be really conservative because we are talking about the year beyond the year 2028. So really, I really like to be really extremely conservative here. And adding to the fact that we have uh, we have an inflation rate in the US, in Europe, of something like 9%. So really, it is expected that there will be interest rate hikes in all these years in order to reduce that inflation rates. And I could assume that the inflation rate in the long term, I mean, in these years, could be something like 4%, 5%. So really, what I want to assume is that the growth of free cash flow at least should cover the future inflation rates here. And another proof, of course, that this is just a conservative scenario here is that in the past, this company, Intel, has been able to deliver at least in average 8% of growth in free cash flow in the past 9 years here. So really, and considering that the company has made all these investments and all this transition period from the year 2022 to the year 2026, it is well expected that the company could offer more than 4% in growth in free cash flow here. And this is the present value of all this sequence here. Now, in order to calculate the present value of this number, given the fact that we are in the year 2022, well, we will take this number and we will divide it by 1 plus the discounted rate here at an exponent 6, because there is a difference here of 6 years. And then, well, we will consider the present value of all these cash flows here. And then we will take this, the cash of the company here. So here, for example, the company has a cash and equivalents of 4.8 billion here, and but of course the company has a short-term investment in trading assets 21.4 and 2.1 billion, which combined are 23.5 billion here. And this is something that I'm considering here, 23.5 billion here. I'm considering because all these short-term investments could be turned into liquidity so easily, so I could consider them as part of the cash here of the company. And then, well, this is a total debt that I just mentioned about, that I'm considering here, the $100 billion that are required for this turnaround here. And then this is the enterprise value here of the company, adding all the perpetuity and the present value of the all this cash flow here from the year 2022 to the year 2027. And then I'm adding all the cash here, and we are subtracting the total debt here. Okay, so really we could divide this enterprise value by the outstanding number of shares, and this is the approximately intrinsic value per share of Intel here. So we can find the different intrinsic value according to different conditions here. For example, what happens is if after all this turnaround, the company is able to generate a better free cash flow, for example, of 22%. Look at this, how the intrinsic value could increase here. And this is something completely reasonable, because look at this, if you look into the past, the company was able to deliver something really similar to 22%, 23, 27% of free cash flow over revenues here. So really, this is something that is completely feasible here. But then I like to, of course, to put myself in the worst case scenario here. And then what happened, for example, if the growth that we're assuming here first, which was 4% for the free cash flow beyond the year 2026, beyond the year 2027 here, what happened if the company really can make an interesting growth of 6% here of free cash flow here. And look at this, how the intrinsic value could be changed here substantially. Given the fact that we are paying a really low price, I mean, the price really is something like 41, 42, $43 per share. Really, we are buying the possibility that this turnaround that Pat Gelsinger is leading could be successful. This is the kind of thing that you are buying here. And of course, if you notice here, we are assuming here a 6%, and probably you would think that 6% is too high. Well, you need to remember that the average growth of free cash flow in the past 9 years was in average something like 8%. So really, I'm not saying something that is beyond reality here. So really, so when we are really considering here the $51.29 per share, it means that we are just isolating potential catalyzers, potential changes, and we are putting ourselves in the worst case scenario here in order to see if even in those worst case scenario, what could be the intrinsic value per share. And even with that, we are paying a lower price than that intrinsic value of the worst case scenario. That, of course, could be a really great opportunity for us here. So in this part, I will assess the how was the performance of Pat Gelsinger before he has taken over as a CEO in Intel here. You know that he was working in a company, this company VMWARE, from the year 2012 to the year 2020 here, and this is a company that offers different services related to the computing, cloud mobility, networking, and security offerings, and provide a dynamic and efficient digital foundation to more than 500,000 customers globally, supported by an ecosystem of 75,000 partners here. So really, well, this company offers to its clients the possibility to have a multi-cloud service here. So really, this is a really interesting company that you can check it out here. So really, the thing here is that with all these years, we can see if really Pat Gelsinger had a really long-term vision respect to this company, and in that way, we could make a decent projection, decent forecast here. If really Pat Gelsinger could have a really decent chance to make this turnaround that most Intel investors are expecting here. So really, so then look at this. He really was focused in delivering a double-digit growth here, and this is because probably, well, he had established long-term vision, a long-term strategy of expanding the operations of VMware through different markets here. So really, this is consistent growth of double-digit, and this is something that we could expect in Intel here. But not only he was focused in delivering a double-digit growth here, but also that this growth should be profitable. Look at this in the case of the net profits here. The net margin has been consistent over the years here, which means really that the company really was expanding and adding value to its service here, to its customers really, and that is how this company could achieve a consistent net margins over the years while it is growing. But something really important is that how the company was able to deliver a stable and growing free cash flow over the years, and taking care about the free cash flow margins respect to the sales here. And this is something really important because this percentage of free cash flow generated by the sales is really something that has been consistent for VMware under the Pat Gelsinger's tenure. And I think that this is something that could be achieved in Intel as well, taking into account that in the case of Intel, the free cash flow over revenues, if you remember, is something between 16%, 24%. So I'm sure that Pat Gelsinger could have the incentives to increase that portion generated free cash flow with all this turnaround that a higher or increasing long-term debt was necessary to support the growth in revenues for VMware. And this, but even with that, you can notice here that long-term debt divided by the free cash flow is less than 1.5 here, which means that the long-term debt can be paid in less than 1.5 years here, with the free cash flow generated in the year 2020 here. And then, well, the return of equity here has been really good here, growing and consistent here. And then, well, you can notice that Pat Gelsinger has a really shareholder orientation here, because look at this, that apparently he felt that the stock market price of the company was undervalued, so that's why he was allocating money to make more repurchases of its own shares. And look at this, how much these repurchases represent from the total free cash flow generated by the company in each year. So really, this 42%, 50%, 30%, 20%, really, it's an important amount allocated to make repurchases. And something you should notice is that the company has not paid dividends except in the year 2018. But then you can notice here that in terms of capital appreciation of the share of the stock market price of VMware, from August 2012 to January 2021, which is of course the period in which Pat Gelsinger was conducting the business, it was only 60.44% of capital appreciation. Probably you would say that this is not something high. It would have been a better capital appreciation, because as we can see the performance of the company, I would say that the stock really deserves a higher capital appreciation here. But really, we need to consider here that there has been certain things that could influence the capital appreciation or at least the movement of the stock here particularly in the last 3 years here. You need to remember that there has been rumors here in this year that the main owner of VMware, which was Dell Technologies, which held something like more than 80% of the total shares of the company. And the rumors were that Dell Technologies would spin off the VMware in the stock market. So really, you know that whenever there is a spin-off, there is a pressure of the stock that is subject of the spin-off to be goes down basically. And this is because, well, you know that in the case, for example, in cases in which the institutional investors are holding Dell Technologies as part of the spin-off, they will receive a part of the VMware shares here. So really, this institutional investor probably most of the time do not have the interest to receive this kind of shares, so they will start selling off all of them. Even when the performance of the company has been stable and is predictable for the future, probably they are not interested, and this create an opportunity for those investors who truly knows how to take advantage of the spin-off situation. The important lessons that we could get from this situation is that really Pat Gelsinger is really focused on deliver a double-digit growth in sales, which is, I'm sure that this is something that he will pursue with Intel, and of course he really is concerned about the net profits and free cash flow generated by the company. So he wants to build up a company that is sustainable over the long term here. This is really interesting. And something important here is that he is shareholder oriented. He likes to make repurchases, to allocate certain amount of money to make repurchases to reward its shareholders, which is something that he will continuously make in Intel here. The only question that I have myself is what will happen with the dividends here, because Intel is making an important amount of dividend payments, and apparently in the foreseeable future, according to what Pat Gelsinger has said, Intel will not stop paying dividends. I mean, this is something that will calm dividend investors because they will continuously receive their 3% of dividend yield for the next years, even when the company is making this transition and reinvesting so much money in making this turnaround here. So Gelsinger is a professional, is a man that is really concerned about the long term, and he will establish a solid foundation in all this period of the next 4 years, in which, well, he will have the opportunity to make this turnaround. And of course, that could be a really good opportunity to invest in this company that is right now undervalued here. And while waiting for this potential successful turnaround, the investors could receive this 3% dividend yield. Well, in this part, I will talk about what are the reasons why the stock market is rather very bearish with respect to Intel here. So in this way, we could understand about the opportunity that could represent Intel according to the price that the stock market price is offering right now, which is something like 41, 42, $43 per share here. You can notice here that there are different challenges that the company will need to face in multiple fronts here, which is something really important to understand, because really we are not talking about just one business unit. We are talking about different services, different segments of the market in which Intel will need to improve, and the turnaround that is under the leadership of Pat Gelsinger here is pursuing all these different multiple goals here for the next 4 years. I mean, but I think that really Intel has the chance to improve in its all these multiple fronts here, like in the case, for example, of the improving its foundry services, improving the design of its chips, improving the manufacturing of its chips, really. And I would say that Pat Gelsinger, according to what we have seen in his previous performance with VMware, we could expect something positive things respect to this man. Of course, we need to remember that Apple was one of the most important clients of Intel, really. Apple has been working with Intel for 15 years approximately here. So really, and then you know that Apple is working with Taiwan Semiconductor, really. But of course, if Intel achieved to improve its foundry services, Apple could come back to Intel. I think that Intel has really a great opportunity to improve its services in order to not depend so much in Taiwan Semiconductor, which is something that could be really desirable for companies like Apple here. Then we have, of course, another very sentiment in the high-end manufacturing front. You know that we are talking about Taiwan Semiconductor, who is really the leader right now offering better technology using the DOB equipment provided by ASML, which is part of the plan, of course, of Intel as part of their roadmap. When Intel would start releasing its 7 nanometer, it will need this DOB equipment provided by ASML. But of course, in the year 2023, this equipment could be really upgraded respect to the same equipment that has right now Taiwan Semiconductor. So really there are different things and different subtle things that we could see with respect to Intel, that really Intel has the opportunity to catch up its main competitors here. But of course it will depend of the work of Pat Gelsinger here. And then we have seen in this video here, we have in the design front, really advanced micro devices and NVIDIA are strong competitors here, but they will still rely mostly in Taiwan Semiconductor. So really, if Intel achieves to improve its foundry services with a better technology and infrastructure, advanced micro devices and NVIDIA could be future customers of the foundry services of Intel, which is something that could be really great for this company. And right now, Pat Gelsinger has the opportunity to achieve that goal. So here I will mention the important catalyzers of this company. You know that in the last part I was talking about the why the stock market was bearish, and this is because you know that stock markets in general do not think so much in the long term. So if they don't see important tailwinds in the next 2 or 3 years, of course they would turn into bearish. But of course, given the fact that in this channel we have a long time horizon for our investments, of course it's important to take into account this kind of vision when we are analyzing any company here. So that's why I'm considering this as an important catalyzer here for Intel if you want to consider this company as part of your portfolio here. So really one of the important catalyzers, of course, is the new product strategy IDM 2.0, which is all the strategy that we have talked about. As part of that is new strategy, the company will build new fabs in Arizona, Mexico, Ohio, France, and Germany to compete directly with Taiwan Semiconductor and Samsung in the foundry services. You know that the foundry services could represent a critical business unit for Intel in the future. And another important point is that the US government will support entirely the semiconductor industry with the CHIPS Act here. Putting 52 billion for the sector here, which is really important because, well, despite the fact that we could not expect a benefit in the short term, in the long term, Intel could have an important tailwind here because the company could find different new ways in which the company could reinforce its moat, reinforce its competitive advantages with respect to Taiwan Semiconductor and Samsung in the very long term. So really, this is something that you need to take into account here respect to Intel. Then, well, Pat Gelsinger is making sound strategic moves, is recovering the manufacturing leadership, attracting top talent, and investing in the future here, which is really an important different skills and characteristics of Pat Gelsinger. And then we have there is an increase in interest of more than 100 potential customers for Intel's foundry services, and Qualcomm and Amazon are among them. But we cannot dismiss the possibility that advanced micro devices or even NVIDIA could be potential new clients in the future of the foundry services if and only if Pat Gelsinger is able to improve the technology, improve the infrastructure, and for the next years of the foundry services of Intel. So why Warren Buffett and Charlie Munger did not invest in Intel or in other stock from semiconductor industry? Well, the thing here is that after reading so much about Berkshire's letter for the shareholders of Berkshire Hathaway, really, I could notice that it is hard for them to make predictions for the long term under this industry. So given the fact that they are investing for the very long term, I'm not talking about just 2, 3, or 4 years. We are talking about 5, 6, or even 10 years. It is really hard to make prediction about who will be the winners here. So the winner players now could be the loser ones in the future. So this is something that you need to take into account right now. So given the fact, for example, that advanced micro devices or NVIDIA are right now the winners, they could be the loser ones in the very long term. And Intel could be the leader of the market again. So we don't know, and this is the kind of things that don't like to Warren Buffett and Charlie Munger. Really, another important point is that these companies are capital intensive companies really. And of course, despite the fact that the stock portfolio of Berkshire Hathaway, there are some companies that are capital intensive, but they have a really low weight within the portfolio. The great part of the majority of the most important positions of Berkshire Hathaway are asset-light companies, which is something really important because it means that Warren Buffett and Charlie Munger really likes to have to hold companies that do not need so much capital to remain competitive here. And this is because, well, most likely these companies have their competitive advantages are based on the brand. In the case of Intel, yes, the company has the brand until some point. Then it is important in the semiconductor industry to remain competitive. If NVIDIA, for example, or Advanced Micro Devices just stop delivering high performance chips, the customers or the market in general will stop buying the products of NVIDIA and Advanced Micro Devices. So that means that in the semiconductor industry, the brand has limited strength. Of course, there are other super investors who truly pursue this value investing philosophy, who are holding right now Intel. This is the case, for example, of Seth Clarkman here. So this is the portfolio of Seth Clarkman here of Pat Post Group here, and you can notice here that Intel is the third most important position here of his portfolio. The position has been reduced in 8% in the last quarter, but still it represents 9% of the total portfolio here. So after making all this extensive research respect to Intel, we can get interesting insights with all this information here. That, well, we can see, for example, Intel stock as a corporate bond with a 4 or 5 year maturity that offers a 3% of coupon here. And this is because, well, one, there is a limited downside risk for Intel because the company is still undervalued. And of course, we can take advantage of the 3% of dividend yield year over year for the next 4 or 5 years, while waiting for the chance that Pat Gelsinger could make a successful turnaround for Intel here for the next 4 or 5 years. So here, for me, the interesting play could be to invest in this company for the next 4 years or 5 years until this turnaround is finished. Then it would be necessary to evaluate if Intel could still be part of our portfolio after that turnaround. And that would be, of course, this is up to you. You will need to assess what would be the conditions in the next 5 years and see if really it's convenient or not to hold Intel in beyond 5 years here. So really, this is really an special situation here. And of course, I'm saying that there is a limited downside risk because, well, as you have seen in our calculation of the intrinsic value, the company is undervalued really. And not only that, and there is a higher chances that there is a significant proportion of the shareholders in Intel or investors of Intel that are dividend investors, which means that they will not sell their shares unless the company stop paying dividends, which is something that will not happen in the next years, according to what has said Pat Gelsinger respect to the dividend payments, that Intel, of course, will continuously pay in dividends for the next years. And the reason why I'm saying that this could be an interesting play, to invest in Intel for the next 4 or 5 years, it is because this is the period that will last all this transition, all this turnaround here. And of course, if you invest in Intel and Pat Gelsinger is successful in making a successful turnaround here for the next 4 or 5 years, you not only will benefit from the 3% of dividend yield for the next year, but also you would experience an interesting capital appreciation for your money particularly at the end of in the year 4 or in the year 5 of all this transition here. So really, given the fact that all this turnaround depend on Pat Gelsinger, for me, it makes sense to see how was the performance of Pat Gelsinger before he has taken over as a CEO in Intel. Just looking into the numbers of VMWARE because he was working there for almost 10 years. So of course, something that I like to see, of course, was the fact that VMWARE was delivering double-digit growth, which means that Pat Gelsinger liked to expand its operation, to expand its presence in different markets, in different sectors through acquisitions or growing organically. And of course, being sustainable, delivering growing and predictable free cash flow, net margins, and of course, reinforcing its balance sheet here, which is something really important. And of course, he's really shareholder oriented, as we have seen in the performance of in VMware, making continuous repurchases of its own shares whenever he feels that the stock market price was undervalued. So there are different things, of course, that could help us to understand different patterns in the behavior in the management decisions of Pat Gelsinger. Of course, the intel is different from VMware, but something for me that was crucial to determine was the fact that he has really a long-term vision, and from that important characteristic, we could see that there could be an increasing chance that he will be able to make a successful turnaround for Intel for the next year. So for me, it was important. For me, it is in my humble point of view, respect to the what could be the probability that Pat Gelsinger could make a successful turnaround for Intel. I think that it could be higher than 50% of chance, but of course it will depend on your own assessment according to all the information that I just presented to you in all this video. So really, I hope that you really have enjoyed this video. Please put a like if you consider that this is a video that is adding value to your investment knowledge. Consider to subscribe if you think that this channel uh, could generate more knowledge in the value investing philosophy. I will continuously delivering more and more information about different companies, different concepts, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.